Hello, welcome to Strictly Money at the News Farm, where all voices matter. I'm Saijal Patel. It's been more than a week since the 2022 federal budget was unveiled, and while much of the focus was on housing and environmental measures, there was one important proposal that, if you blinked, you may have missed. The feds outlined a plan to introduce a single nonprofit external body to address consumer complaints about banks. To help us break down the significance of this and what it means for investors' rights is Jean-Paul Bureau. He's the Executive Director at Fair Canada. Jean-Paul, great to have you on.
Thank you very much for having me.
So this is an amendment to the Bank Act and the Financial Consumer Agency of Canada Act to improve the way investor complaints are being handled or will be handled. What was wrong with the previous way things were done?
Well, they haven't yet made the change, so it's still the way things are being done today. But right now, the issue is that the banks get to choose who they want to use to help them resolve the complaints. So they call these the external complaint bodies. And right now, there are two that are formally approved at the federal level. One is OBSI, and the other is ADRBO. And so the banks get to choose where they want to ultimately bring their complaints to. The consumer has no choice. It's the banks that get to choose.
Okay. And I understand it's also for profit, the one that the banks get to choose, right?
Well, yes. So they can choose either one, but there's only one that is for profit, and that's ADRBO. And so that creates some, reasonable apprehension that maybe the banks will favor that one complaint handling body because one might expect that maybe that one body is a little bit more generous in terms of the favoring the banks because it is for profit. So one is reasonable to kind of question their motivation.
Okay, so now this change, can you explain that?
So the change going forward, and it's not entirely clear exactly how it will roll out. What we do know is the federal government is going to amend the legislation to remove the ability of banks to choose. We don't know, but we assume that the banks will be required to use OBSI going forward. And we assume that if it's not OBSI, it'll be another ombud service, but that it will definitely be a not-for-profit ombud service.
Okay. Jean-Paul, do you think this is exactly what was needed, or do you think they could have gone farther? And I guess what I'm trying to get at is are there still loopholes, do you think, that could be exploited here?
Well, there are still a lot of issues with the complaint handling system. This will definitely be a big improvement for bank customers. But there remains a fundamental problem, is that even though you can go through this entire complaint handling process, at the end of the day, the ombudsman's decision is not binding on the bank. So the banks are free to ignore it. And so that is a very fundamental flaw in the current system, and is something that Fair Canada has been advocating for quite some time.
Why do you think this has taken so long? I mean, when you look at the sort of these details, it just feels like there's some people who have been asleep at the wheel. Like, why is it taking so long? And I guess my second part is what's the timing of it? When could this pass?
Well, this issue of binding has been debated in Canada for over 10 years.
Wow.
And I know this on the securities regulators are working hard at trying to find a way to create a binding system. I think why it's taking so long is, the industry is not particularly willing to be bound by somebody else's decision in terms of how they should deal with their clients' complaints. And we have to be honest about that. But I think there are also some challenges, and some people will argue due process and the right of an appeal and, in terms of the decision that's made. And so there are some legitimate issues that need to be thought through and figured out without making the process even more complicated or time consuming than it already is.
All right, we're going to take a quick break. We'll be right back. Welcome back. Jean-Paul, this was not part of the budget announcement, but I've seen a lot of posts and comments about this. And this is the recent news that Ontario's finance ministry is now proposing a new set of rules governing employees in the financial services industry who use the title financial planner as well as financial advisor. How important is this?
It's an important development in Ontario. I think everyone's financial well-being is very important, and most of us have to turn to people to get some good advice when it comes to our personal financial situation. And so we want to make sure that we're dealing with people who are capable and competent and can give us good advice.
Okay, then who could actually use the term financial advisor that perhaps didn't fit the bill?
Well, the new legislation, it's actually now been proclaimed. So before it was proclaimed, anybody pretty well could call themselves, for example, a financial advisor. They didn't have to meet any minimum proficiency requirements or any educational requirements. They could basically just set up shop and call themselves a financial advisor and just, give advice. With the new piece of legislation that just came into effect in Ontario, you will now be required to meet certain minimum standards that are going to be established by what they call credentialing bodies. In a sense, you're going to have to take some courses through one of these bodies, pass their courses, and at the end of the process, you'll receive a credential saying that you're either a certified financial advisor or planner.
Okay.
So it's an interesting system, though, because the government is not they're not regulating financial planners or advisors directly. They are relying on these credentialing bodies to, set the standards and to monitor how their members are, meeting those standards.
Okay, so they're self-regulated bodies, really.
Yes, you could think of it. That would be a good analogy.
Okay.
So what the government will regulate is they will look at people who are using the titles as, let's say, financial advisor, who have not yet gone through one of those credentialing bodies. They'll police that kind of activity, but they're going to rely on the credentialing bodies to police the conduct of their members. So if you're getting bad financial advice from somebody who's a certified financial planner, you're going to have to take your complaint to the credentialing body where they got that credential from.
Okay. And does this mean that they will have fiduciary duty? I know that comes up quite a bit.
They're not subject to fiduciary duties. The credentialing bodies will have a requirement to have a code of conduct and ethics. And in that code of ethics, there will be a requirement based on what the government proposed that their members, the financial advisor, for example, act in the best interest of their clients.
Okay.
But that is not the same as a fiduciary duty.
Okay. Jean-Paul, we have about a minute and a half left. The last time you were on was at the end of October, and we talked about decoding investment fees and how those fees are not still fully transparent. Any update on this?
Yes, apparently the securities regulators are working on a project called the total cost reporting. And we're hoping that will, there'll be a concrete proposal made hopefully this year. We understand they're on track to do something. And it'll be an important development because once the proposal is adopted, it will give investors all the information in terms of all the fees they're paying, regardless of whether they're paying those fees directly or if they're paying those fees indirectly. So, we still have to wait, but there will come a day when investors will have complete information about the fees they pay as investors.
And where do they find this out? Where can they find more information about it?
Well, right now, investors get an annual report on fees and the performance of their investments, but that information does not reflect all the fees. So what I anticipate will happen is the regulators will make some changes to that annual fee report to require additional information.
Okay. Thanks so much for coming on today. We really appreciate it. Welcome back to Strictly Money. So if you've gone to a bank or spoken to a financial advisor about investing in a mutual fund, there's a good chance that you've been offered an option to buy a segregated fund. That is a fund that offers a guarantee when the fund matures or when you pass away. Now, depending on your situation, a seg fund may or may not make sense. And to help us decipher all the considerations is Jason Heath. He's a fee-only financial planner with Objective Financial Partners, and he joins me now. Jason, great to have you on.
Yes, thanks for having me again, Saijal.
So I am really glad to have you explain seg funds, because I know so many people who've been offered this. I've been offered it. My parents have been offered it. And on the surface, it seems great because, who doesn't like a guarantee? but I know it's not that straightforward. So maybe explain first what a seg fund is.
So a seg fund, a segregated fund, it's kind of like a mutual fund in that it's a large pool of money that's invested by a bunch of different investors in a bunch of different investments, whether it's stocks, bonds, a combination. There are segregated funds that are 100% in stocks. There are segregated funds that are 100% in bonds. There's segregated funds that are a combination of the two. And when an investor invests in a seg fund, whether it's $50, $50,000, $500,000, you own a small proportion of the big pool of assets that's managed by the fund company. I think one difference compared to a standard mutual fund that people are used to is that a segregated fund is structured as an insurance contract. It's issued by an insurance company. So as a result, there are certain guarantees, as you mentioned, benefits, protections, things like that, compared to an investor that owns a mutual fund. And those guarantees typically come into play when, as you mentioned, the fund matures or after a certain period of time or when the investor dies.
Okay, so let's talk about the guarantees, because my understanding it is also varies, right? It depends on the type you're buying. Like some are 100% guaranteed, but not necessarily.
Right. Yeah, some contracts will guarantee 75%, some will be 100%. The guarantee is based on your initial contributions minus any withdrawals you've taken. So it's a principal guarantee, which sounds good. I always tell people when it comes to financial products, when you hear guarantee, that usually means expensive. And I think that's really important. The guarantee typically applies after 10 years or upon death. And over a 10-year period, it's very unlikely for a diversified portfolio of investments to have a negative rate of return. So even a 100% guarantee, let alone a 75% guarantee, may not be that valuable after all.
Yeah, so let's talk about that, because in your experience, does that guarantee really even make sense? I always say, well, like, why wouldn't you just buy a low risk, diversified, blue chip fund that over 10 years will likely go up? And if you really want that guarantee, you buy maybe a GIC. Wouldn't that make more sense?
I think so. I think a diversified portfolio is probably going to give you a better outcome. I can't say for certain, but I suspect that in nearly all 10-year periods that you could pick, you'd come out better off in a diversified portfolio of investments, in large part because of the fees that are involved with seg funds. Yeah.
So what are the fees? Usually a typical mutual fund is about 2% MER. Yep. Compared to that, what does a seg fund charge?
So seg fund fees tend to be about 1% higher than a typical mutual fund. As you mentioned, in Canada, the average fund fee is about 2% for a mutual fund. So seg funds are typically in the 3% range, which is pretty expensive regardless of how you invest your money. But I think often the people who gravitate toward guarantees are more conservative investors. And I think that's what can make seg funds even less appropriate or more challenging, because if you're paying 3% in fees and you're in a conservative portfolio where the bond portion's earning 3%, you're paying 3%. I mean, 3 minus 3 is 0. So you might have a good portion of your money that's just going sideways.
Yeah. We have about 45 seconds until the break. You mentioned there's a period that you would be locked in for. Does that vary? And if you do sell beforehand, is there a penalty?
Well, sometimes mutual funds or segregated funds can have deferred sales charges where there is a penalty to get out. You may be foregoing the guarantee, but again, the guarantee may not matter. Your principal, particularly, given how markets have performed in recent years, will probably be, well protected and then some. There are some other benefits to segregated funds related to creditor protection for business owners, related to estate planning benefits because they can avoid probate and estate administration.
So hold your thought on that, Jason.
There are other reasons why.
Welcome back. Jason, before the break, you were talking about when segregated funds do make sense and estate planning. You can use it there, and as well as creditor protection. Let's go through that. Talk about the estate planning piece.
So on the estate planning side, if you own segregated funds, because it is an insurance contract, you can have a named beneficiary that upon your death, the account pays out to directly. Some registered accounts like RSPs and TFSAs can also have named beneficiaries where assets pass directly to them. But in a non-registered, like a taxable investment account where you can't normally have a beneficiary, if you own a segregated fund, it can bypass probate, it can bypass here in Ontario estate administration tax. Providing a death certificate can be enough to have the funds paid out, as opposed to going through the process of probating a will, legal fees, costs, time involved, and other complexities.
Okay, so presumably then you have to actually hold the fund, and when you do pass, so the underlying assets, something conservative would then make sense, wouldn't it?
Yeah, it can, have an estate planning benefit. I think the real challenge is even here in Ontario where, probate or estate administration tax is 1.5%. If you're paying an extra 1% per year for 10 or 20 years, is that worth it to then save 1.5% on the back end? So pros and cons to the estate planning benefits for sure.
Okay, and creditor protection?
Yeah, so there is creditor protection because it is an insurance product. It's not considered a regular type of asset. So business owners are often encouraged to consider segregated funds. So a segregated fund that you own in a non-registered account or in a corporate account, for example, may have creditor protection. Often our RSPs, depending on the province or territory in which you live, have creditor protection already. So there is some limited benefit for sure for business owners or other people who might be exposed to creditor risk.
Okay. I want to switch gears, Jason, and talk about universal life as an investment strategy, because it's kind of different, right? It's, again, insurance product, but then you have this investment piece. So it's sort of, I don't know if you call it reverse. But when does it make sense to buy a universal life policy? Because I get asked that question a lot.
Yeah, so I think most people are familiar with sort of typical term life insurance where you buy a policy for a 5-year or a 10-year term, you pay a premium. If you die during that period, it pays out. Or you've got group insurance at work, which is group term insurance. Universal life insurance is a type of permanent life insurance that combines insurance with an investment component. So you can contribute more to the policy than just the pure cost of the life insurance premiums, and use those contributions to buy mutual funds effectively that can grow on a tax-deferred basis subject to certain conditions related to the policy itself.
So who does it make sense for? I mean, I have to think, well, you just mentioned tax deferred. So I assume when you use up, say, your RSP contribution room and your TFSA contribution room, it would make sense for someone who's in a more higher tax bracket?
I think so. I think that if you haven't already maxed out your RSPs and your TFSAs, universal life insurance, may not be appropriate. The benefits are that much more so for someone who's building taxable non-registered investments, who's, as you mentioned, in a high tax bracket. Candidly, most of the universal life insurance policies I see are not that profile, interestingly. So I think it's really important to understand what the benefits are and take advantage of other RSP and TFSA contributions that may be simpler and more beneficial in the long run from a tax perspective.
Okay, we have about 30 seconds left. What does someone have to consider though when they buy it? What should they be aware of? I guess fees. There must be some sort of stipulations.
For sure. One of the big challenges with universal life, the investment component tends to have higher fees than alternative investment options. So you may be saving tax, but you're paying higher fees. Is it worth it? I think the other challenge is the insurance premiums tend to be quite high. And particularly if somebody hasn't already done a good job of covering themselves off in other areas like, disability insurance, which can be really important, but can have really high fees. You shouldn't be jumping into an expensive life insurance policy that's fancy when you haven't dealt with other parts of your risk management through insurance.
All right. Jason, thanks so much for coming on today. Really appreciate it.
Thanks for having me, Saijal.
Jason Heath of Objective Financial Partners. Well, that wraps up this edition of Strictly Money. If you have thoughts or questions about the show, drop us an email. We'd love to hear from you. Until then, stay well, stay wise, and stay wealthy. We'll see you next time.